They're blocking redemptions. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, we've been warning investors to get their money out before it's too late, and we're now just got word that a major investment bank is blocking redemptions from one of its funds. And what I want to suggest to you is this is only the beginning of what is a story in the next couple months and later this year of what we're going to hear of more and more companies not just blocking redemptions, but outright halting them. And of course, we're going to go back and I'm going to show you why this is happening and why it's only going to get worse. Plus, we've got some data from an unusual source that says the economy is indeed slowing down. Let's go to Bloomberg, where we picked today's story up with the headline: PIMCO-owned office landlord defaults on $1.7 billion mortgage. Now, this we talked about earlier this week and suggested that, look, this issue with commercial real estate is going to get worse and worse and worse. And the simple reason is not just due to inflation or rising interest rates. It's a story of the post-pandemic economy where workers want to work either entirely from home or hybrid work schedules. And so the need for office complex and office space is going down. It's going to put downward pressure on prices, and landlords aren't going to be able to command rent and then lead to a default. And here we're seeing the beginning of what we said was coming. We, like most office owners, are addressing the unique and unprecedented challenges currently faced by our asset class and customer base. This, a spokesperson for Columbia Property Trust. We've engaged with our lenders on a restructuring of our loan on 7 properties within our larger national portfolio. We look forward to a collaborative process yielding thoughtful solutions that reflect the current market conditions and best serve the interest of our stakeholders. And let's translate this. Look, we're looking for an outcome that you're going to agree to, because if you don't, we're going to default. Now remember, if you owe the bank $10,000, the bank owns you. You owe the bank $100 million? Well, you own the bank. And in this case, these landlords know they have these property companies on the hook for these properties, and they can negotiate the price down, or they'll simply just walk away. And that's not what anybody wants. That's what they're talking about, a thoughtful negotiation. Well, one that ends in their favor. So now we're seeing the beginning of what the story is here, is landlords are going to start to default because they can't fill their buildings, they can't command the rent. And then what else are we going to see then follows after that? Well, if you're guessing price declines, you got it. U.S. housing market posts $2.3 trillion drop, the biggest now since 2008. And after peaking at $47.7 trillion in June, the total value of U.S. homes, now I know we were just talking about commercial real estate, but put the big picture together here, has declined by $2.3 trillion or 4.9% in the second half of 2022. That according to Redfin. That's the largest drop in percentage terms since 2008 housing crisis, when home values slumped by 5.8% from June to December. So of course we know this is going to impact the commercial real estate market as well. And generally, as prices go up, then rents go with it. Prices come down. Well, what do you think tenants are going to ask for? Well, they're going to want lower rent. Of course, the landlords at this point are just going to have to default on their contracts to force a renegotiation. We'll see how well it works, but I think the landlords have got this one on their side. U.S. housing market hit with the biggest 6-month wipeout, but to be sure, home prices are indeed not collapsing, according to Bloomberg. In December, the total value of U.S. homes was still 6.5% higher than a year earlier, giving investors some reason to pause and say perhaps that everything's going to be okay. Hey, homes just went up a whole lot. They're just pulling back a little bit. As long as they don't keep going down, we're okay. But is there something that may indicate that we are going to see a collapse in real estate prices? And that's why I think this commercial real estate issue is going to be a huge one. And I'm going to predict that what you're going to see during the next recession is a push for everybody to go back to the office. The hybrid work schedule, the work from home, it's all going to go away because you're going to see employers demand their workers come back. I want to show you why, of course, on this next chart, that I think prices are going to come crashing down in a big way. And of course, we have to look back to a story from yesterday's show, to crude oil. Here you can see the S&P Case-Shiller U.S. National Home Price Index, this in blue on a year-over-year rate of change against West Texas Intermediate Crude, this priced in dollars per barrel. And here what we can note, going back into the early 90s, we see a big surge in crude oil prices, started putting downward pressure on the year-over-year rate of change in home prices. And look at this, as crude oil came crashing off of that peak, look what happened to home prices. Well, they actually went negative. And let's go into the great financial crisis here, where you can see crude oil prices rallying, started putting a slowdown on home price growth because of the new expense of energy going up. And then all of a sudden you see a little pullback in energy and it rockets higher. The year-over-year rate of change collapses into negative territory. Crude crashes. You get a massive, of course, financial crisis. Now let's look at what's happened again here. We see crude oil prices rallying. We see home prices going up as well. And next thing you know, crude oil prices start to come down. The year-over-year rate of change is slowing. Again, they're still saying 6.5% growth. Hey, that's pretty good. It is. But what happens next? Let's go back to the chart. And if crude oil prices, if history repeats and we see crude oil prices come crashing down, which I think we can make the case for, well, that tells us that home prices are likely to go negative here. And that is not a good sign. That it's going to impact the commercial real estate market. And if you start to put the big picture together, the reason these companies are going to stop redemptions is really simple. They can't sell the property when everybody wants to get out. And that's what we're going to look at in our next story here, is to understand that people are investing a ton of money in these type of investments, these real estate investment trusts. And what they're going to find is the door's not just going to be closed, it's going to be slammed shut and locked, and they're going to be stuck there. But one thing you shouldn't be stuck with is your position in the market. Many keep asking me, how do you know the market was going to go down? Well, our positioning report on CTA Timer Pro, I added 5 more coupon codes. People emailed me, hey, I missed it. I didn't get in. I want it. In the description below, you can see the fast algorithms going short here. The longer, slower algorithms are still holding long positions. But if they start to flip and sell, and of course, we'll cover that more on the Sunday show, well, you can watch out below. Now let's look at these redemptions that we could have predicted a long time ago. We're going to get blocked. Well, here you go. Credit Suisse cuts property fund payouts as investors exit. The Credit Suisse Real Estate Fund International's net asset value is expected to drop as much as 10%, according to a statement on Friday. That will likely limit distributions to investors as low as 35 francs a share, down from 40 a share, and what will be only the beginning of their limitation. Investors holding about 13.3% of the fund share have asked to get their money back. You can only imagine, my friends, these buildings are illiquid. The assets underneath these real estate trusts are illiquid. They can't just sell them. When you start to see and hear word of people having their withdrawals limited, what's going to happen is more people are going to want their money out, and eventually prices are going to collapse. Credit Suisse isn't the only firm seeing its property holdings suffer in a down market. In January, BlackRock suspended withdrawal requests. See, there you go, on its $3.5 billion UK property fund. Yet Credit Suisse's fund has been struggling for a while and has underperformed, giving people even more cause to sell against its peers over the past 5 years, and down almost 5% in that period. But now let's look at some other evidence that shows the economy here is indeed slowing down. And sometimes you have to look at places you might not normally, but that is, of course, the pizza market is telling us here demand is coming down in a big way. And what that all just suggests back to our show yesterday, the crude oil indeed is a fantastic leading indicator of where the economy is going. Check this out. Domino's and Papa John's shares sink after pizza chains deliver soft sales. Soft, we'll say they completely blew it out. Both pizza companies have raised prices recently to offset, well, we'll just say inflation. And Domino's reported wavering demand amid a national driver shortage. So this is important. If the economy was booming, demand for things like pizza wouldn't be a big deal. So what you would see is people's demand to eat out would go up. But here we're seeing prices went up, demand comes down. Let's look at just briefly at some of the details of these reports. The Michigan-based U.S. company said same-store sales increased by 0.9%. Didn't keep up with even inflation. How about that? This was a 0.8% decline for fiscal year 2022. That's not a sign of a booming economy. Revenue grew at 3.6% in the fourth quarter of 2022 compared to a year earlier. Also, far lower than the inflation rate. Again, they cited higher supply chain revenues as a result of increases in market basket pricing to stores. Well, how about lack of demand for consumers? And let's look at Papa John's. We see the same story here. The company missed estimates of its own sales, reporting revenues of $172 million versus expected 172.7. But here's the deal. The comparable sales were up 1% from a year ago. And that is, again, we talk about missing the inflation boat. Demand here is an issue. You see it in the pizza market, and the company expects its North America's comparable sales to grow annually between 2 and 4%. While at the current rate of inflation, that is not good. That means they're underperforming. Demand's too weak. What we're going to see now is property prices are going to start to come down. You're going to see investors start to get cut off from their money. They're going to demand it out. It's going to put further downward pressure. And if crude oil is that signal that we talked about in yesterday's show is right, and I think it is, well, get ready. We may not be in a third quarter or fourth quarter recession. We might see it as soon as the second quarter. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.